They don't want what we know out there.
How a person can go from really almost nothing to becoming a millionaire by owning rental properties.
He would always buy these flip houses, and I just remember thinking, this guy is crazy. Why would he buy that house?
In the past decade, there's been a huge surge in the peer-to-peer short-term rental market.
Become an insider. So you have to know the rules before you get in the game.
Every second counts. So make every second count.
Welcome to the Real Estate Jam. Whether you're just beginning or the best of the best, we're glad you're here. We will share successes, failures, and strategies for the action-taking real estate investor. And now to your hosts, JD and Melissa.
Hi, guys. Welcome to the Real Estate Jam podcast. I'm JD with my lovely co-host.
Hello, JD.
Melissa, how are you?
Happy Monday.
Happy Monday. I'm glad to have you back in the office.
Thank you. Missed you.
So I'm really excited to bring to you guys a short term, or not a short term. I'm sorry.
You got short term on the brain.
Yeah, I do. A storage unit expert. Melissa, please help me welcome Jacob Vanderslice.
Hey, Jacob. Thanks for joining us.
Good to see you both. Thanks for having us on today.
Jacob's done a lot of real estate investing over the years. About 2015, he shifted his focus over to storage units, and we're really excited to kind of deep dive that. Jacob, for our audience who maybe doesn't know who you are, can you give us a rundown of how you got started and where you're at now?
Yeah, we're a private equity shop based out of Denver. We're VanWest Partners. We've been investing in real estate full time since about 2006. And initially, we did a lot of single family rentals and fix and flips. We've done some adaptive reuse, retail, townhome development, multifamily. We've covered a lot of bases. And we got in the storage business in 2015 with a development project here in Denver. And our intention at the time wasn't necessarily to completely pivot to storage. It was more just kind of try a deal out, see how it went. And we kept doing more. And over time, we evolved to becoming primarily a self-storage owner-operator.
Well, that's a pretty big shift, and there's a lot of pros to getting rid of tenants and toilets and all of that kind of stuff.
So my question, sorry to
go ahead.
interject here, because I don't think anybody really talks about it. So when people are doing self-storage, are they doing the management of the individual properties, or how does that work? With where's your control over it, I guess, is what I'm asking, right?
Mm-hmm.
Yeah, it depends on how you, let's say somebody wants to be in the business. They've got a couple different options. They could buy stock in the REITs, right? That's one way to get exposure. They could go out and buy their own storage facility and own and operate it. Or they could invest in a private vehicle like somebody like us or somebody else. And those are kind of the three ways to participate. If you're doing your own deal, as it relates to your question about management, some operators will self-manage their portfolio. So they'll build their own management brand around self-storage, and that's the management company that operates their portfolio. That's what we do. Other operators will outsource it to third-party management companies like Extra Space, CubeSmart, Public Storage. Those are some of the big ones. But it's kind of like multifamily to a degree. If you're investing in an apartment building or buying an apartment building, you might self-manage it. You might hire a third party to run it for you. So
Okay.
It kind of depends.
Sure. And what is that property management fee roughly? Obviously, everything's negotiable, but what are those big box managers charging operators?
They're charging around 6% of monthly gross receipts. I mean, there's a little bit of flexibility there, I think, based on the portfolio that you have.
Sure.
But one of the, I think, disadvantages in self-storage, outsourcing your management to a larger operator like a REIT, is there's a fair amount of ancillary revenue in the business, specifically tenant insurance. It's almost like car rental insurance. You probably decline it when you travel because you have coverage on your Chase Sapphire card or your auto policy. Well, in storage, we require our customers to have insurance, and the REITs keep a big piece of that insurance revenue, depending on who the REIT is. So you famously, if you're paying a REIT 6% to manage your facility, you're actually paying them a lot more with overhead allocations and ancillary fee income. But that's about the industry average, depending on the deal.
And can you tell our listeners what a REIT is? Because some of our listeners.
Yeah, forgive me. A REIT is simply a real estate investment trust. It's a large publicly traded company. There's multifamily REITs, there's industrial REITs, but we're talking about self-storage now. So we're talking about self-storage REITs. Yeah.
Awesome. Great. So what kind of properties are you guys specifically targeting? How many square feet or rentable square footage are you guys looking for? What size? And then roughly how many units is one project?
Yeah, we were talking before we started recording. You guys are obviously in Panama City. We have a bunch of deals in the Florida Panhandle. And to give you a flavor, some of those deals are smaller facilities that are drive up, non-climate controlled. Other deals are multi-story climate controlled facilities. So it really depends, but I would say our average, we typically measure deal sizes in net rentable square feet. And I think our average is about 60,000 feet. We have deals up to 120,000, and we have deals as small as 25,000, but kind of that 60-ish range is where we've averaged on net rentable square feet. So we'll do deals that are smaller if it makes sense. Maybe it's a smaller deal near a larger deal we already own and operate. We can amortize some of those fixed costs across a larger asset base. That's generally the range that we target.
And I guess I'm curious in how you guys are finding these deals. Are you working with commercial broker or somebody that specializes in storage units? Are you guys going direct to seller? What are you looking for, and how are you finding them?
Yeah, we're doing all the above, and deal flow has been challenging. And that kind of transcends asset classes. I think right now, storage, multifamily, residential, there's a wide bid-ask spread between what sellers are expecting for pricing and what buyers can actually pay. And I think that's translating to reduced transaction volume, just fewer deals are trading because people are just not meeting at a price that makes sense. Our deal flow is mostly sourced through broker relationships. I don't use this term lightly by any means, but 65% of it's off market, meaning nobody else has seen it. It's brought directly to us. Off market deals can sometimes be not really off market deals, right? Shopped around and everyone's heard about it.
Right.
The balance of our deals are sourced in two different ways. We do a fair amount of direct to seller marketing that we learned from our single family days. We'll send a business letter out saying, hey, we're not brokers. We're interested in buying your storage facility. We could probably pay you a price that's pretty attractive. Let us know. We've gotten a few deals from that. And the deals that we've bought that were marketed have been overall kind of inefficiently marketed. Maybe someone's got a cousin who's a residential broker and puts a storage facility for sale on the MLS. Nobody sees it. Generally, if it's a widely marketed deal with a national brokerage outfit, we probably can't compete. There's still a lot of money that wants to be in the space. There's still very little inventory available to buy. And if it's out there in the world, we'll put our hat in the ring, but rarely do we even come close to the price that it trades for.
Sure. That's the exact same way for us with the single family homes. Like if it's on the MLS, if it's been marketed, it's probably not a deal for us. But in those deals, we're looking for significant value adds that maybe other people aren't seeing. So I'm wondering with your guys' deals, when you see these properties come in, obviously you can't pay top dollar and then do it. You're an investor. So what are you guys doing for the value add portion? Are you just buying it at a below market value? Are you buying it and then increasing rents or decreasing expenses? What are you doing to bring value to the deal to make it worth it for your time and effort?
Sure. Commercial real estate, as most of us listening probably know, it trades on a multiple of the income stream it produces or a capitalization rate. And cap rates have an inverse value or inverse relationship, I should say, with values. So the lower the cap rate, the higher the value of the property. So we'll target deals that are generally undermanaged, kind of mom and pop ownership groups. They're inefficient with revenue management. Their operating expenses are high. In some cases, they don't have a website. They don't increase rates. We bought a deal in Illinois a few months ago. They hadn't increased rates on their customers for 10 years, which is good for their customers, but not good if you're trying to create value from an NOI growth perspective. So depending on the deal type, we'll buy deals that are lower physical occupancy. And our year one plan on those is not so much revenue management, but just filling up vacant units. And then we'll also buy deal types that are higher physical occupancy. And our year one business plan on deals like that is simply bringing below market customers up to market rates, adding in ancillary revenue streams, and of course, controlling our operating expenses. And whether we're buying a low occupancy or a high occupancy deal, our target's always really one simple thing, and that's growing NOI. growing net operating income. And we do that by pulling those different levers through our management platform.
Sure. What are the other types of income that you're the ancillary income? What are you doing? Are like U-Hauls and boxes, or what else is there?
Yeah, you're exactly right. So there's a few different types of these income streams. One is U-Haul truck rentals or Penske, boxes and tape sales or merchandise sales. And then some of the bigger ones actually are late fees, which is obvious. If you pay late, you get a fee. Right. Administrative fees, which is a one-time fee that a customer incurs when they move in. And then lastly, tenant insurance. So a lot of people are kind of surprised to learn that in a self-storage lease, customarily, the owner of the facility is not responsible for the tenant's belongings. So fire, theft, flood, it's not ownership's responsibility. So we require our customers to either present proof of homeowners coverage on their policy or buy tenant insurance from us. It's kind of like car rental insurance to a degree. And the sum of all these different ancillary revenue streams, late fees, administrative fees, tenant insurance, truck rentals, boxes and tape, they make up about, year to date for this year, they're about 10.5% of our top line revenue. So it's pretty meaningful. So you could buy a deal and do nothing else, buy a deal that has none of these income streams in place and simply layer these in. And the first year you can grow your revenue by 10%. So sure. It's a meaningful component of our overall value creation strategy.
That's awesome. I like that.
It is definitely a value add that if you're doing it and you have the systems in place and you can just duplicate from one set to the next, that's super simple. Starting out and learning how to become a U-Haul truck rental place might cause some problems, but if you guys already have it figured out, I'm sure it's just copy and paste.
Yeah. It's a lot of work on our on-site managers to rent trucks.
Yeah. Sure.
The revenue is enough to make it make sense, but it doesn't move the needle a ton. You might get $1,000 a month on a given facility, but if you annualize that and you put a cap rate on it, you've created a fair amount of value.
Sure, absolutely. So I am wondering, when you are going to, so you guys are raising money and you're doing these deals, I assume you're taking on limited partners. Can you talk to me about like what the typical timeline for your investment or what your plan is? Are you guys getting it under contract, stabilizing the rents, increasing the value, selling in 5 years, 10 years, 3 years? Or are you holding these forever? What does that look like?
Well, if it was up to me, which it's not, we would hold them forever.
Right.
But it's not up to me. It's hard to raise capital saying, hey, invest in our fund and we're never going to sell. But I promise it'll work out, right? So we're doing two different types of things in storage. Outside of our fund, which is Fund 3, we're doing single asset syndications and we're doing development projects. So we're building new storage. We underwrite those for a 5-year hold. So if you're building, that'll take you, to answer your question about contracts, on a land acquisition, it's almost not fair to make the comparison, but I will anyway. So when we go under contract on a development project, we're under contract for over a year before we close the land. And during that year, we're getting all of our entitlements done, our design work. After we close, it takes us about 15 months to build the project. And then thereafter, from opening, it takes us about 2 years to lease it up and stabilize it. And then we show a sale on year 5. Our fund is only buying existing storage facilities. It's not doing development. So in our fund, we underwrite a 7-year hold from the date of each acquisition on each property. And our contract leading up to that is typically a 30-day DD period, a 30-day close, sometimes 45-15, sometimes 60-30 if we can get it. But value add acquisitions, you have a much shorter runway because there's no reason to use all that time up. You're not getting entitlements done. You're not working on a building permit. You're just buying a storage facility. So those are kind of the different comparisons. One's very different from a revenue timing perspective, contract to close timing perspective from the other.
Yeah.
Sorry, you guys keep doing this, but DD would be due diligence, correct?
Yeah, and it's almost like if you're buying a single family home on the MLS, you're probably hiring an inspector. They're doing a sewer scope, they're doing a radon test. I guess not in Florida because you don't have basements, but Colorado we do those. Roof inspection, all that stuff. So we're doing similar things during our DD due diligence period or inspection period on a storage facility. We're confirming the zoning is allowed use. We're getting a property condition report, which is kind of like an inspection report. We're getting a survey to make sure that we're buying the land that we think we are and there's no encroachments on it. We're doing unit audits. We're getting copies of the rent roll, trailing income statements from the seller. So kind of similar reports that you might expect to get on a single family acquisition, but a little bit more just given that it's a commercial facility and an operating business.
And you as the buyer do the surveys and those kind of things, because I know they can get expensive.
Yeah, we hire third parties to do those. We do all the underwriting ourselves, but surveys, appraisals, property condition reports, we pay for that out of pocket during the contract period. And on an acquisition deal versus a development deal, those third party reports probably run 25 to 30K, something like that. Plus you're putting up a deposit of anywhere from 50 to 500K, depending on the deal size. So you have to have some cash you're willing to put out there kind of during this inspection period. And if you spend money on those third party reports and you don't buy the deal, it's kind of a sunk cost, just like getting an appraisal or an inspection on an MLS residential acquisition that you don't close on. You're kind of out of luck there if you don't close.
Just at a much higher price point.
Yeah, a lot higher.
Yeah, higher gross dollars, but as a percentage of the deal size, it kind of makes sense, right?
Sure. Yeah. No.
Yeah.
So now, so you guys are running a fund, and then you're doing individual syndications. Some of the questions I have now are in regards to the fund, because, and I guess I should add, are you guys actively taking on money into the fund? Is that a continual process?
It is. So it's a close-ended fund, which means we have a defined period to get our capital raised and close on acquisitions. And once that period comes and goes, we close the fund to new investors and new acquisitions. So we are actively raising capital for that. And one thing that might be somewhat valuable to touch on briefly, in private real estate, there's really two types of vehicles out there. One is a syndication, which is a manager will go out and raise capital for one deal, one LLC, one asset, one location. And then a fund is structurally pretty similar to a syndication, but a fund is a collection of assets. So investors are participating in the economics of a larger asset base versus one deal. There's benefits and detriments to both, but one of the benefits we think of a fund structure versus one deal, and to be clear, we're doing both, is that a fund inherently offers, we believe, more geographic and cash flow diversification than one deal does. You're investing in a portfolio of 20 properties versus one asset. And if 2 or 3 of those underperform in a given quarter, they're balanced out by the other 17 or 18 that are performing on or ahead of forecast.
Sure. Yeah, that makes sense. And right now, the syndication timelines versus your fund timelines are roughly the same, right? If 5 to 7 years.
Yep. Correct. Yeah. But the big difference, though, if whether it's with us or somebody else, is the expectations of when distributions start. Mm-hmm. So if you're investing in a development project, I mentioned a moment ago, it's going to take you over a year to build it and 2 years to stabilize it. Mm-hmm. So no one's getting any cash flow for at least 2 years. Whereas if you're buying an existing acquisition and you're buying a trailing revenue stream that you're just growing over time, those cash flow distributions would start a lot sooner. So it kind of depends on your risk appetite, how important growth is to versus income. We have elements of both on both of our strategies, but development's a little bit of cash flow and mostly growth on the sale, and the fund is kind of 50-50 between growth and income.
Sure. And are you guys are specifically with the fund, I assume that it has to be all accredited investors, but your syndications, are they accredited investors or non-accredited investors or both?
Yeah, we do 506(d) designations on everything, which means we can only accept accredited investor capital. And accredited investor simply means, for those of us who aren't clear, if you're married, you're making $300,000 a year. If you're single, you're making $200,000 a year, or not both, or your net worth is $1 million outside your primary residence. So if you check any of those boxes, you're accredited. And there's other designations out there. That's a 506(c). There's a 506(b) that allows for a certain number of unaccredited investors, but B designations are not allowed to generally solicit or advertise for capital raising. So we generally do the C's just because we market a fair amount, and I think it's a better more safe vehicle, I think, to raise capital under.
Right. You're not going to say the wrong thing and end up with a SEC violation or any of that.
Right. Well, we could still do that.
Well,
but
yeah, that's true.
I think the chances are a lot lower with a C versus a B. Exactly.
Right. And I guess it just to clarify a little bit, somebody who the government deems as an accredited investor is viewed by them to know what they're doing with their money and are able to judge the riskiness of the investment that they're moving into, whether that's true or not.
Yeah, that is the man's thesis. I'm accredited. I don't really know what I'm doing, so I'm not sure. I'm not sure how they determine that. But yeah, I think they, someone sat around in a room some years ago when they came out with this legislation, and they decided that these are the income thresholds or the net worth threshold, and somehow if you meet one of those, you're smart enough.
Yeah. I know a lot of people that make that, and they're dumb. For sure. They're just lucky.
And I know a lot of people who don't make that and are really smart.
Yeah, I'm right there too. I'm just a simple real estate hack. Yeah.
Well, awesome. So if our listeners wanted to find out either more about self-storage investing, or if they wanted to find out more about your funds or syndications, where could we send them so that they could, learn more about it?
Yeah, we always love to talk about real estate. They can email me, jacob@vanwestpartners.com. They can go to our website, which is vanwestpartners.com, or they can hit me on LinkedIn, Jacob Vanderslice.
Awesome, Jacob. Well, we really appreciate you.
It was a lot of info.
Yeah, it was definitely a lot of info. We do appreciate your time.
Thanks for having us on, guys.
Thanks, Jacob.
Awesome.
Thank you for listening to the Real Estate Jam. We hope you enjoyed today's episode. For more information, check out our website, therealestatejam.com, or find us on Instagram, Facebook, and Twitter @The Real Estate Jam. If you have any questions, feel free to drop us an email at therealestatejam@gmail.com. See you next episode.